Wall Street bonuses down 8% from last year. Still pretty hefty, though. The average bonus on Wall Street, more than $128,000. New York State Comptroller Tom DiNapoli here with more. All right, so when you look at the total number for Wall Street, more than $20 billion in bonuses. But this number, a little bit lower than last year, but this is just showing us how Wall Street pay is changing, right? Yeah. Not that Wall Street's not doing as well.
Correct. And this just looks at the cash part of the cash bonus part of compensation. It's something we track, and we've tracked for close to 3 decades in the Controller's Office, because it has an impact on state revenues, particularly this time of year being budget time. So you're right. The message is the overall pot of the cash bonus pool is down. But when you look at overall profitability with Wall Street is certainly back. We see total compensation up by about 6% when you take in all aspects of compensation beyond the cash bonus pool part. So I think it does reflect changes in compensation patterns.
So what we have seen across the board at the big firms is a stronger base salary. There's a lot of criticism on the big bonuses, so stronger base salary and also this deferred compensation. Yeah. How much is that really the case, especially the deferred compensation? You know, during the height of the crisis, we heard about clawbacks and different that being instituted into Dodd-Frank. But are we really seeing that yet? This deferred focus on long-term, not short-term?
I think we are, and I think that's an evolving picture, and you're going to see more of it over time. There's certainly. And I think this is good for the industry, certainly good for the city and the state. We depend on revenues, and we like consistency. We don't like volatility. So the more we tie compensation to long-term sustainable profits, I think that's a good thing. The kinds of peaks and valleys that we've seen and how that's disrupted the markets, what that's done to everyday investors, what it's done to New York, a state that's very dependent on the health of this sector of our economy. I would trade the volatility, the peaks and valleys, for a more consistent pattern in terms of revenue.
But what does this do to New York's coffers? I mean, you can tax bonuses at a higher rate than you can tax regular income.
Well, in the past, this time of year, when we get the huge cash bonuses, there'd be a windfall of revenue, and we'd use that to, in a sense, paper over the structural deficit that was built in the budget. We ended up making spending commitments based on an expectation that those outsized windfall cash bonuses from Wall Street would happen every year. So then we have the meltdown in 2008. It's all gone, and we're still dealing with the reverberations of that. So the good news right now for the current budget process we're going through, this bonus revenue is coming in pretty much where we projected it. So it doesn't make our budget decisions any easier because we don't have an outsized revenue coming in, but it's not going to make it worse. This is pretty much on target with how we have projected it.
So do you think, Tom, that we have seen real substantial changes in behavior, more risk aversion within these big and smaller firms, whether you're talking about hedge funds or big public institutions?
I think we have, and I think we're going to see more of it. I think in the long run that's going to be good. And keep in mind, deferred compensation will be paid out at some point, and at that point there'll be the tax revenue that'll come in. So it's not, from a revenue perspective for us, as long as it's there at some point and with a little more predictability and without the big drops that we've had, I think that's going to be a good thing.
What about the disconnect between the fact that banks across the board are raising their fees, they're getting rid of things like free checking, they're making it more expensive for the average person to bank? And then we see these bonuses. There is this disconnect here. And, the question of whether it's fair or not is a moot point. Life isn't fair. But what do you make of the disconnect?
Well, I mean, it's certainly there. You're right. And certainly when the markets crashed and everyday people got hurt, in terms of their own portfolio, their money markets, whatever, I think that certainly ramped up the anger and frustration at the industry. But I think the industry understands that, and I think the smart leadership that is embracing the enhanced financial oversight and regulation, I think that is the right response to that disconnect that is there. But it is a love-hate relationship in some ways, because for New York, we need the sector of the industry to do well. We need folks to get the bonuses and go home, whether it's a neighborhood in the city or out on Long Island, Westchester, and spend the money in the shops and in the restaurants. It's a key. It has a key multiplier effect. Sure. We say for every job created on Wall Street, 2 other jobs are created in the city and another job outside of the city, usually in the downstate suburbs. the reverse is true also. When Wall Street is shedding jobs, it reverberates in the other part of the economy. So you're right, we lost about 30,000 jobs. That is part of what's been driving the very sluggish recovery that we have, because it's reverberated to other sectors of the economy. So love them or hate them, we need folks to make money here, and we need those tax revenues, and we need this industry to be sustainable, profitable, and we need New York to continue to be the finance capital of the world.